Come back to Helper Dad. Younger investors have time on their side for long-term growth, and ETFs offer a fantastic way to diversify investments at a low cost. For those just starting out, focusing on growth-oriented ETFs can help maximize returns over the long haul. But remember, this is not financial advice, so do your own thorough research. Let's delve into what growth ETFs actually are. These are exchange-traded funds specifically focused on companies that are expected to grow at a rate faster than the market average. They typically exhibit higher volatility compared to value ETFs, but also come with the potential for significant capital appreciation. These ETFs often include companies in the technology, healthcare, and consumer discretionary sectors. However, be aware of the risks. They are susceptible to market downturns, and growth stocks can sometimes be overvalued, making a long-term investment horizon crucial. In selecting growth ETFs, several key factors should be considered. First, the expense ratio, as lower expense ratios directly translate to more returns for you. Ideally, target expense ratios below 0.2% if possible. Also important is the tracking error, which measures how closely the ETF mirrors its underlying index. Minimize tracking error for more predictable performance. Assets under management, or AUM, is another factor. Higher AUM often indicates greater liquidity and stability, so avoid ETFs with very low AUM, typically under $50 million. Also, understand the index methodology. Know how the underlying index selects and weights its stocks, considering factors like market capitalization, growth metrics, and profitability. Finally, look at holdings concentration. Diversification within the ETF matters, so avoid ETFs overly concentrated in just a few holdings. Let's look at some top growth ETFs suitable for young investors. First, the Vanguard Growth ETF, or VUG, tracks the CRSP US Large Cap Growth Index, features a low expense ratio, and is well diversified across large cap growth stocks. Second, the Schwab US Large Cap Growth ETF, or SCHG, tracks the Dow Jones US Large Cap Growth Total Stock Market Index, and offers an even lower expense ratio than VUG, with similar holdings. Third, the iShares Russell 1000 Growth ETF, or IWF, tracks the Russell 1000 Growth Index, providing broader exposure to growth stocks than VUG and SCHG, including mid-cap growth companies. Fourth is the Invesco QQQ Trust, or QQQ, which tracks the NASDAQ 100 Index, heavily weighted towards technology stocks, offering higher volatility but potential for strong growth. Finally, consider the ARK Innovation ETF, or ARKK, an actively managed ETF focusing on disruptive innovation, offering high potential reward, but also high risk, and featuring a higher expense ratio than passively managed ETFs. In building a growth-focused portfolio, consider your asset allocation, factoring in your risk tolerance and time horizon. Allocate a larger percentage to growth ETFs when you're younger, and diversify with other asset classes like bonds and international stocks as you approach retirement. Employ dollar-cost averaging, investing a fixed amount regularly, regardless of market conditions, to reduce the impact of market volatility. Also, practice rebalancing, periodically adjusting your portfolio to maintain your desired asset allocation, selling overperforming assets, and buying underperforming assets. Conclusion: growth ETFs are powerful tools for young investors looking to build wealth over time. Remember that careful research and a long-term perspective are essential. Consider your risk tolerance and investment goals before investing. Start building your wealth today. Thanks for watching. See you next time on Helper Dad.